presentar al profesor Toporowski. Es un especialista en Kaletsky, es un especialista en el sistema financiero internacional y creo que podemos hoy día hacer una discusión muy importante en términos hacia dónde va el sistema financiero internacional, hacia dónde va la estructura bancaria y teniendo como base qué pasó en el sistema Bretton Woods. La primicia, where is your book? Es que el doctor Toporowski acaba de sacar un libro sobre ese tema que hoy día lo quiere mostrar y Rosalía, en este sentido, tomarlo en cuenta, no lo trajo para vender, no es buen, you're not a good dealer. Bueno, permítanme darle la bienvenida en inglés. Thank you very much for coming. I hope you as always can put together Kaletsky's view, the history, Bretton Woods failure, and what's going on today with the banking structure. If you speak loudly, if you speak, we can manage. I'm sorry for the...
Okay. So, yeah. Thank you very much, Naomi, for this lovely introduction. I apologize for not having brought more copies of this book with me. The reason for that is that I did not fly directly to Mexico. I flew here via New York, where I was involved in a research discussion with some. I was involved in a research discussion with a number of other economists, including central bankers, and it was an opportunity to find out more from them about what they thought is happening in the banking system at the moment. And unfortunately, they didn't know very much. But what I have found out, I will talk about later on in this lecture. So yes, can we move on to the what I'll talk about today is, in summary, Kaletsky's critique of Bretton Woods, which in particular highlighted the capital and monetary needs of the developing countries. This was distinctive for a serious discussion of the Bretton Woods plans, of the Keynes and White plans. The critique that Kaletsky put forward has become even more relevant because of the growing private sector foreign borrowing in developing countries, the way in which developing countries and emerging markets, firms in developing countries and emerging markets are expanding their borrowing in the money markets and the capital markets of the rich countries, the financially developed countries. And then the third point is to say that I think that the present difficulties in the international monetary systems have behind them fundamental problems of capital markets rather than short-term bank credit. And I think this is very, very important, because if you listen to what the International Monetary Fund are saying, if you listen to what the central bankers are saying. They want to think, and they want, and they believe that this is a problem purely of short-term banking credit within the interbank system. But this is not the case. There is a long-standing problem in the capital market, and by the capital market, I mean the market for long-term finance, and this is what we need. This is what needs to be understood if the present difficulties are going to be overcome. So yes, let's move on. Kalecki's critique of Bretton Woods. Yes, this is a picture of the front of this book. It was a book that was set up about nearly 5 years ago, when the Polish ambassador to the Organization for Economic Cooperation and Development, that is the group, the international group of the rich countries, but including Mexico. Mexico is a member of the OECD. The ambassador wanted to have a discussion about Kalecki, and they asked me for my opinion on this, and I said that I didn't think that people in the OECD would be very interested in Kalecki in general, but what they would be interested in is Kalecki's views on Bretton Woods. Why? Because the OECD is interested in the international monetary system, and we were approaching the 75th anniversary of the Bretton Woods conference, and I thought this would be an appropriate time to re-examine this Kalecki's criticism, and also to see how it would fit in with other criticisms. So, yes, if we the principal contributors to this book are Jesús Shatinsky, who sadly died just over a year ago. He is probably not at all well known in Mexico. If his name is found in the library, it's because he was the editor of the collected works of Kalecki, and a monumental intellectual project, which I think put forward a particular view of Kalecki, which continues to be re-examined. So Jesús Shatinsky contributed to this book, and a second major contributor was Julio Lopez, who will be familiar to many people here, who will have been known to many people here because of his long service to UNAM here in Mexico City. We tried to get Julio Lopez into the conference that was held at the OECD to discuss this book, but unfortunately he was already ill, and when we were preparing the book, we asked him if he would work with a collaborator, Hanna Szymborska, who would write a chapter with him. So there is a chapter in this book, and it's probably the last thing that Julio Lopez wrote. There is another familiar name in the book, and that is who is sitting next to me, Noemi Levy, who is who contributed, I think, the key chapter to the book on the growth of foreign borrowing by the private sector, because this, we argue, is the major difference between now and the period of Bretton Woods. At the time of Bretton Woods, during the war, most governments, the governments of the major economies of the world had taken over control of the foreign assets, but also foreign borrowing of the private sector, so that in effect bringing into the government sector foreign borrowing. What happened since has been the rise of the private sector borrowing, and this, we argue, is the major difference, and Noemi Levy has written about this. Peter Clark is a distinguished historian who's probably the historian who best understood the work of Keynes. I know that the Keynes's biographer was Robert Skidelsky, and is probably even known here in Mexico. But Peter Clark's work, I think, is better. Esteban Perez Caldente and Matias Bernengo wrote a chapter on Prabish. Why Prabish? Because Prabish, like Kalecki, saw the position of the developing countries as being critical for the success or failure of Bretton Woods, and they saw it. They saw the way the developing countries were treated in the Keynes and the White Plan as being major weaknesses in the Keynes and White plans. And finally, Stephanie Griffith-Jones, who will be known to many of you, who is a economist now working in Chile with the Chilean Monetary Policy Committee. Stephanie Griffith-Jones has written a great deal on the issue of financing industrial development, and she contributes a chapter on that. So, yes, let's move. Let me say now where the problems were, the problems that Kalecki identified in the Keynes and White plans. Keynes wrote about this in collaboration with another economist, Ernst Schumacher, probably better known here for his book "Small is Beautiful," but Schumacher collaborated with Kalecki on the critique, which focused in particular on the problem that affected both the Keynes and the White plans, although they thought the Keynes plan was better than the White plan, but they said that they both had an idea of equilibrium, of international equilibrium, as being achieved when foreign trade is balanced. And this is they believed, both the Keynes and White plans argued that balanced foreign trade was compatible with full employment, at least for the industrialized countries. Both Keynes and White were like all the other participants at Bretton Woods, had experienced the Great Depression of the 1930s, and all of them wanted to get back to a position of stable, sustainable, full employment. And they believed that this could be achieved with balanced foreign trade. The problem was that neither the Keynes plan nor the White plan provided instruments for governments, policy instruments, to secure balanced foreign trade at full employment. We all know that the problem for very many countries is that as they approach full employment, they get to incomes increase and the demand for imports increases, and somehow you have to make exports expand at the same time. The solution that Keynes and White put forward was a solution of actually adjustments to the exchange rate. But both of them realized that the lesson of the 1930s was that if you let countries use the exchange rate, governments use the exchange rate as an instrument of policy freely, then you would get problems of inflation and also international monetary instability. So both of them wanted the exchange rate adjustment to be regulated and controlled, and in particular, under both plans, any exchange rate change had to be, which was significant, had to be done with the approval of the International Monetary Fund. Now, this was this was a problem that Kalecki identified because actually it is by no means the case that if you devalue the currency, that you can get to balanced trade. The condition for doing this is that your exports and your imports have to be fairly elastic with respect to the exchange rate. And this is by no means always the case. In fact, it's very rarely the case, and it's very rarely the case if countries go into foreign trade using the standard foreign trade doctrine of comparative advantage. if you are trading in accordance with comparative advantage, you are specializing in exports of the good in which you have comparative advantage. This means that you do not have the capacity to switch production for the domestic market in accordance with changes in the exchange rate. So exchange rate inelasticity is built into the standard procedures for foreign trade that are recommended by economists. For developing countries, there is a need for excess imports of capital goods. This was always well known that if countries wanted to, at the beginning of the industrialization drive, those countries would run trade deficits. This applied as much to countries in Western Europe. It applied to the United States in the early years of industrialization. You have to have capital imports in order to industrialize. And although the Keynes and White plans did incorporate plans for an international investment bank to finance development, this was by no means on the scale that was necessary for developing countries, and the scale that became very, very apparent after Bretton Woods. Let's remember that at the time of Bretton Woods, most developing countries were still colonies of or within spheres of influence of the United States or European countries, and it was subsequent to Bretton Woods that the realization came that all these countries would need to have some sort of assistance with economic development. I think Kalecki and Schumacher were pioneers in seeing this as early as the wartime period. Latin America, incidentally, was in this respect was different. The countries of Latin America were not, by the time of Bretton Woods, were not colonies, but they nevertheless remained in a dependent position vis-a-vis the United States, with in a very particular kind of dependency, which we will go on to. Yes, let's look at the next. Kalecki's solution for developing countries was that there's a solution of long-term credits for industrialization from the International Investment Board. And this was something which he believed should be applied almost automatically, because if you don't provide these kinds of credits automatically, you run the risk that governments are forced into shorter-term borrowing, and the shorter-term borrowing gives rise further down the line to financial instability as governments find themselves trying to refinance their borrowing. There was behind all of this a political problem, a political problem of who determines the industrialization strategy. Was it going to be the developing country government or the governments controlling the IMF and the World Bank? And both Kalecki and Oskar Lange highlighted the fact that the Keynes plan and the White plan gave control over the international investment credits to the boards of the World Bank or the IMF, where the United States and Britain had control. That is for the British, it was an essential problem. Why? Because the underlying subtext, the hidden truth that everyone knew but no one spoke about at Bretton Woods, was that the British international financial situation, international monetary situation, was unsustainable after the war. Why was it unsustainable? Because the British, the value of the British currency depended on the arrangement whereby India, as a British colony, kept its reserves in London. India was on a silver standard, but as a colony, the Indian Empire was on a silver standard, so this allowed it to keep gold reserves in London, which weren't used for the domestic money supply in India. But India had a very active independence movement through the first half of the 20th century, and in the 1930s, the British government had, at the outbreak of the Second World War, the British government had promised the Indian nationalists that on conclusion of the war, India would become independent. Everyone knew this, and everyone knew that when India became independent, the gold would go from London. So the British needed something which would strengthen an international system, which would strengthen their position in the international monetary system. And that was the Keynes plan. The Americans, for their own reasons, had no reason to support the British Empire and rejected the Keynes plan and instead opted for the White plan. But in any case, they wanted a system that would keep control over credits within the IMF and the board of the World Bank. Into this come the writings of Raoul Prabish, which were not known at the time of Bretton Woods, because Prabish was writing, it was in Mexico at the time, and was writing his commentary on what was happening in in Bretton Woods. For him, the Keynes and White plans were systems for eliminating the monetary policy autonomy of the developing countries. He believed that the developing countries could not develop unless they were able to control their own monetary policy, and that monetary policy, if they stayed with Bretton Woods, it would be restricted, and they simply wouldn't be able to develop. I don't have time to go into this, but this critique, I think, is very interesting, particularly in comparison with Kalecki's ideas on the role of monetary policy in economic development. Let me move on to this question of the rise of private sector cross-border borrowing. Both the Keynes and the White plans confused international payment systems with free capital movements. This is an easy confusion to make, because if it's possible to make payments throughout the world, it's easy to think that, in that case, it's possible to move money capital, large sums of money around the world. And this was by no means the case. Under the Bretton Woods arrangements, and in the years following Bretton Woods, the international mediation of payments, or the mediation of international payments, was made through the central banks. And but what it did not prevent is the accumulation of foreign currency balances within the private sector. This started almost immediately after the end of the Second World War, in particular in American corporations, but also with other businesses and wealthy private individuals holding money in so-called offshore financial centers. Offshore financial centers, in particular, Switzerland, Liechtenstein, and from 1957 onwards in London. In London, although London had capital controls and British residents were not allowed to hold foreign currency, but British banks in 1957 were given a license to open accounts in dollars for foreigners, for foreign residents. This was a way of accumulating dollar reserves in London. Inevitably, these came to be known as the Euro markets, or offshore financial centers. These multiplied through the 60s and the 70s, and in effect, it led to the loss of central bank control over exchange rates and capital movements. And what happened after that, we all know. It was the breakdown of the Bretton Woods system and the shift toward the demonetization of gold and the shift to floating rates of interest. Yes, should we move? What we now have is a situation where the larger economies, the larger developing country economies, are moving into this structure, deregulated structure, and are referred to as emerging markets. I think this gives sometimes gives an incorrect view of what is actually happening, because it suggests that these countries are deregulating their capital movements. This is by no means the case. Many of these countries still have regulations on capital movements, but what is becoming very clear is that multinational corporations and larger corporations were always, to some extent, outside the control of central banks. They could build up foreign currency reserves, but they could build them up in places which accepted such foreign currency reserves. In other words, offshore. And from the 1970s onwards, you have this new phenomenon of emerging market multinationals. These are emerging market corporations which borrow in the financial markets of the developed, financially advanced countries, the US, UK, Frankfurt, Rotterdam, Paris, and so on. They borrow in those countries. Now, if you do this, you have a serious, you can have, if you do this to finance activities in your home country, you have a serious problem of currency mismatch or exchange rate mismatch. If your liabilities are in dollars, but your assets are in pesos, then all it takes is a devaluation of the peso for you to be in serious financial difficulties with your dollar liabilities. And this certainly happened in the case of Mexico. This was behind the Mexican crisis of 1993, 1994. What do the emerging market multinationals do now? They borrow abroad, but they don't use it for investment in their domestic economies. They borrow abroad in order to buy assets in the financially advanced countries. And this is how corporations like Cemex, Telmex have become, in the steel world, ArcelorMittal, the Indian company, Tata Motors. They come from the emerging markets, but their main assets are in the developing world. From the point of view of development, this is useless. Okay, but from the point of view of corporate finance, it makes sense. It makes sense because you have the corporations have an expansion strategy which is hedged by matching currencies of assets and liabilities. You can have you can tap into the hegemony of the US dollar. Why, if you have US assets, you can borrow, and let's say you've issued equity, you've issued shares in the United States, you can then borrow against those assets. And in particular, you can tap into, I think, the latest version of US dollar hegemony, which has emerged since the 1990s, which is the international system of currency swaps, led by, organized by the US Federal Reserves. What are currency swaps? Well, if you go onto the Federal Reserve website, you can find the information about this. Periodically, the Federal Reserve announces a list of foreign central banks with which it will exchange any amount of US dollars for the currency of the other central bank. But this is hedged by a swap agreement, a reverse swap agreement, that the foreign central bank has to sell back the dollars at the same exchange rate. Okay. Now, why is this practice? Why has this been introduced? It's been introduced because, in the first place, it offers both sides an exit route from their commitment, an exit route with no loss, profit or loss on either side. Well, actually, the country that borrows the dollars pays any loss in terms of the exchange rate. Thank you. And this becomes a way of, this allows the other central banks to supply dollars to commercial banks within their jurisdiction. Why has this come to be important? Because if you look at the international, the way in which banking is conducted now, and in particular, the interbank market nowadays operates. The interbank market in Europe, North America, and sorry, not in the United States, but in other countries, operates no longer on the basis of standard interbank borrowing. The traditional model of interbank borrowing was that one bank would borrow from another bank, but the borrowing was completely was unsecured. There was simply a commitment that the borrowing would be repaid. Now it's usually secured by a foreign currency swap organized by an American bank. And what this means is that in times of financial crisis, the way in which, or in times of banking crisis, the way in which it appears is that the commercial banks in Europe, in Canada, in Japan, and in other countries suddenly find themselves short of dollars to reverse their short-term borrowing. So what you find is that the measure of international crisis, the signal for it is usually when the Federal Reserve announces that it will give unlimited amounts of US dollars in these currency swaps. And this is what it did in 2 weeks ago. They started doing this in the period of the emerging market crises in the 1990s. They then established these lines of credit were established in 2002 with the European Central Bank and other European other central banks in Europe, and after 2008 it expanded, including Mexico, Brazil, South Korea. It's a very, very interesting structure. Yes, let's move on. Okay, the current instability in the international monetary system. This, if you read the newspaper, this started off with the Silicon Valley Bank. What happened with the Silicon Valley Bank is not unusual. In the United States actually suffers from the fact that the banking system in the US is highly fragmented. Although we all think of American banks as Chase, Citicorp, JP Morgan, and so on. Actually, most American banks are very small, maybe have a handful of branches, and it makes them vulnerable to to any possible rumors that about the soundness of the bank, in particular because the small banks are community banks. In America, people, economists and bankers get sentimental about community banks. They're supporting the local community. Yes, indeed, they support the local community, but precisely because it's the local community, if stories arise about a bank, it immediately goes around the local community because it's a community. And Silicon Valley Bank, no exception, in particular because the community of its depositors and borrowers were all linked up by social media. That's the community within which they operate. The US banking system and banks elsewhere in Japan, and in Europe had 14 years of near zero policy rates, even longer in the case of Japan. And when very low interest rates didn't work, you had the experience of quantitative easing, which meant central banks buying in for government bonds, in effect forcing down interest rates on longer term government bonds, 10-year government bonds and longer, so that the corporate bonds were being issued at near zero interest rates. It wasn't just in the United States and in Western Europe or in Japan. It was also countries in Africa. I mean, countries like Nigeria, which have regularly, and Ghana, which have regularly defaulted on their debts, were issuing 10-year dollar bonds with on interest rates of 7 to 9%. I mean, this is really extremely low. But this worked fine as long as we had this period of deflation and very, very low interest rates. That continued through to COVID, and then we had, with the end of COVID, inflation starts to rise. Now, the ruling doctrine of central banks, the one that they are all encouraged to hold to, and which is the one that's recognized by the IMF, and that is critical because the IMF is the source of emergency funding for many governments, requires central banks to raise interest rates when inflation rises. But higher interest rates mean lower bond prices, so that over 2022, as the Federal Reserve was raising its policy rates of interest, bond prices were starting to slip. Who was holding these bonds? Well, a lot of the bonds were held by central banks. In some respects, it doesn't matter if they make losses, or does it matter? I think I remember writing a blog about 5 years ago in which I said that the policy of zero interest rates and quantitative easing was turning central banks into hedge funds, because that's what in effect they were. They were gambling on zero interest rates. Okay, yeah, let's have the next one. Yes, overcapitalization, Keynes's funding. How does this come into it? Because overcapitalization is a way of regulating the liquidity of banks and regulating or the liquidity, for that matter, of corporations. It means issuing shares or long-term bonds in excess of the financing needs of the company. Why should you do this, or the financing needs of the bank? Why should you do this? Well, because if you do this, you sell the shares or the bonds, you acquire in exchange bank deposits. You hold bank deposits. Your balance sheet is now more liquid. You don't need so much savings to in case something goes wrong. Overcapitalization is a standard method of regulating liquidity, and it has been for a long time. It's it's even mentioned by Keynes in his treatise on Monday from 1930. It's why the critics of finance who say that bonds should only be issued or shares should only be issued for investment purposes are really don't understand the way the financial system works. No, you need to overissue them if a company or a bank is going to keep itself liquid. The problem with the long period of near zero interest rates was that banks and corporations paid a penalty for holding liquid assets. The return on liquid assets was very, very low. And so what was happening? Well, banks and corporations had started to move into hedge fund business. They themselves were buying corporate bonds and plus government bonds, with the result that as interest rates went up, the value of those bonds fell away. Okay, can we have the next one? Yes, here we've got the yield curve, the normalization of the yield curve. Over the past year, this is the US dollar 10-year bond rate. Started off a year ago well below 2.5%. By November last year, it was around 4%, between 3.5% to 4%. This is the bond rate, but it also means that the price of the bonds has correspondingly fallen, and that in the system of bank reporting, that has to be reported as a loss. So there are two fundamental problems, I would argue. One is that inflation targeting requires higher interest rates. And there are already signs that the central banks, the Federal Reserve, and other central banks are starting to get worried about these continuing to raise interest rates. Their interest rates are still much lower than the rate of inflation, but just raising them slightly, raising them a little bit, has already caused problems in the banking and financial system. But the second thing that I want to highlight, and this is my first point, the one about the central banks losing interest in higher interest rates, is a well-known problem. The second problem is a structural problem within the capital markets. These have been weak since the 1990s. With the dot-com crisis of 2001, the capital market crisis of 2008, there was a capital market big crisis because banks couldn't sell their collateralized debt obligations in 2008. All of these limited the ability of banks and corporations to overcapitalize or to use funding as a solution to liquidity problems. If you flood the financial markets with money, which is a kind of monetary solution to the structural weaknesses, a weakness in the capital market, this doesn't resolve the structural weakness. It simply prolongs the structural weakness. What you have to do is start with the capital market, and in particular, start with the structure of the capital market. Start working, start reviewing not just the short-term rate of interest, but also long-term rates of interest and what you're going to do with those. And this is something which I think has to be on the agenda for central banks if we're going to move towards a stable financial system. The problem is that central banks are at the moment hooked on the idea of inflation targeting. They're hooked on Vixelian ideas that there's a way in which the money rate of interest, the short-term money rate of interest, can be used to regulate the business cycle and the rate of inflation. This is turning out not to be the case. What we have to do is to start looking to the long-term rate. And that, may I say, that's probably a very Keynesian point on which to conclude. So thank you very much for your attention. Have I spoken enough?
Yes.
Thank you very much, Professor Toporowski, for your marvelous presentation. Now we have time for discussion. If you want something to add to this discussion, if you want to ask something, please raise your hand and I can pass the mic.
Puede ser en español o en inglés, pero corto, y si quieres al final podemos hacer una discusión. Ahí yo se lo doy. Okay.
Oh.
Well, thank you very much. Okay.
Well, first of all, thank you for the presentation, Doctor. It was pretty good, and I'm hoping to read your book as soon as possible. My first question, well, the only question I have is precisely what limits the central banks to adopting a strategy related to controlling the yield curve, long-term yield curve, in order to affront this kind of situation that we're living right now?
Yeah. One by one. ¿Alguien más? Pues en español, ¿eh? Well, thank you for your presentation and also for your patience for this colorful country. I have a question for the first part of your presentation regarding, for example, the difference between the Keynes and White plan. I think behind the scene was kind of a problem of the imperialism of the United States against imperialism of the Britain country. Keynes trying to go forward the survival of the Commonwealth, the United States, as a new imperial guard of the new order of the post-war. I think that's Bretton Woods. Thinking, for example, Gillespie, when he thinking about full employment, ask himself about the political aspects of full employment. Thinking about this kind of new monetary system would take into account the developing countries, what would be these political aspects of the international monetary payment system, because we can think from an economic point of view that it's kind of important to take into account developing countries. But if we live in an imperial world, why these high and why these powerful countries will be interested in taking into account developing countries when they get more benefits from putting this monetary system, which can be imbalanced and can be many problematic things, but it's also a power and political economy thing, and not just from economics point of view. Thank you.
We have two more questions.
Yes, the problem of inflation is not the demand, because central bank are increasing interest rate, and this problem is decreasing investment, decreasing production, and the supply problems continue and inflation continue. Central bank can't compatibilize low inflation with stability of the banking system.
Can I repeat
Yes.
question?
Yes. Go ahead. What's happened?
In your opinion, it's Gerardo Arriola. In your opinion, should developing countries like Mexico be more restrictive to abroad banking companies, Citigroup, BBVA, HSBC, etc., to establish financial operations into the country? Could this promote a healthier economic structure into the long term, or contrary, it will threaten the economic stability development on short term due to liquidity restrictions? Espérate, si quiere paramos ahora y hay como 3 preguntas más.
Okay.
Para darle un poco de
aire.
Questions.
Okay. To start with, let me start with the question of political aspects, the US imperialism versus UK imperialism. That most certainly was the case at Bretton Woods, and this is the benefit actually of Peter Clarke's chapter in the book, because he shows how what annoyed the American side and the commercial interests which were influential in Congress and with the American government was the British system of imperial preference. In other words, the tariff that was imposed on trade with all countries outside the British Empire and Commonwealth. So I think it was a fight between US and UK imperialism on political aspects. The other political aspect of this, I think, is one that Kalecki brings out in that essay of his Political Aspects of Full Employment brilliantly, and that is the question of on the question of full employment. But the same thing applies to financial stability. There's absolutely no reason why the system, the capitalist system, cannot have full employment and financial stability. The only reason why this doesn't happen is because the capitalists themselves do not want it, because of the power play of business. In the case of full employment, it's the fact that full employment strengthens the working class too much for for business circles to accommodate. And in the case of financial stability, it's because the business actually doesn't care about financial stability, doesn't care about the system, the way the system as a whole functions. They leave that to the government, and they use finance as a leverage on government policy. As you know, the famous sentence in Political Aspects of Full Employment, that sound finance is a government policy which has the confidence of business circles, and they don't know what kind of policy it is, but anything which favors, which constrains or limits the business is considered to be undermine finance, even when it may actually help finance. So having said this, let me move on to the question of what would bring about a certain degree of financial stability, and that is that I'm exploring in recent years the idea of yield curve management. Yield curve management, not in terms of the government, the central bank managing the returns for corporations on their corporate bonds, but but central banks managing the interest rates on the term structure of interest rates on government bonds. This has been it's a complex subject. It has been tried in some countries, most notably in Japan, but they suffer from this Fixelian delusion that if you lower those interest rates, it will somehow stimulate investment. It doesn't. It actually destabilizes it gives rise to complex shifts in financing structures, certainly in the case of Japan. So what you need is a much stricter yield curve management, so that the governments can operate fiscal policy in a stable and in a way that stabilizes the economy and maintains it at an efficiency frontier. But that's for the efficiency of the system as a whole. As I said before, there will be business circles that will undoubtedly be opposed to it, just simply because they don't want a stable system in which the workers start to acquire confidence and power. The question of decreasing investment. Yes, I think you've put your finger exactly on the problem of the economy. That even if you maintain a stable financial system, investment, a business investment is never going to be stable. There will always be investment cycles, and with that will come business cycles. The only way in which you can avoid this is by counter-cyclical policy of the government. But to have good, effective counter-cyclical policy, the government needs to be able to operate the financial system properly. It needs to have a firm control over the financial system, and that is why yield curve management is important. Foreign banking in developing countries, I can see a function for foreign banking in developing countries. I don't see it. I don't see foreign banks as somehow being part of a system which maintains, or they may be a part of a system that maintains the backwardness of developing countries, but it's possible to have, or the economic backwardness or industrial backwardness of developing countries, but it's possible to have industrial backwardness without foreign-owned banks. So they're not a crucial element. What is crucial is that there has to be a system of an investment strategy for economic development, which has to be properly financed, and proper finance requires long-term finance, and this is what then requires this yield curve management and stronger influence of the government over the financial system. Within that, I can well see a function for foreign banks, but I don't see laissez-faire. But laissez-faire in banking is not a solution to industrial development.
Empezamos con la segunda ronda. Compañero.
Again? 4 questions. You have one?
Yo quiero hacer una, Ignacio, y el compañero, pero que empiece el compañero porque está con el micrófono.
Dr. Toporowski, for your time for this lecture. It was very interesting lecture. I have a quick question for you. Basically, at some point of the lecture, you mentioned that one of the strategies for developing countries would be to be providing credits for industrialization. My question or my concern about that, or what I like your opinion on that is, if developing countries are subject to foreign policies and interests, is there a really possibility of economic growth? I mean, out of that cage we are attached to the foreign's interest? And my second question to you, it's about the bitcoins and all these type of currencies that it's showing up in these times. I would like to know your opinion on that. Does that may affect or interfere in general monetary policy, or does that affect at all, or something may change something? There are some countries that are trying to apply this type of currencies in their regular uses. So what's your opinion on that? And once again, thank you for your time.
Well, first of all, Jan, congratulations on this wonderful talk that you gave us today. And also, of course, congratulations on your new book. I'm looking forward to reading it. So, well, I have 2 issues. I have 2 questions for you. And the first one has to do with the insights that you put forth with regards to Kaleshki's analysis of the new international monetary and financial system that was under discussion in the 1940s. And of course, Kalecki was always concerned with income distribution. And as I see it, the reason why he put forth his ideas, in a critical way, not only with respect to the White Plan, but also with respect to Keynes's ideas on Bretton Woods, was precisely because he was concerned with the impact of the new international monetary and financial arrangement on income distribution. And I would like you to elaborate on that connection and on that link between the international monetary and financial system on the one hand and income distribution on the other hand, in particular with regards with the role of capital markets, because Kalecki was very much concerned with the impact of finance on income distribution. And the second issue has to do with one of the two fundamental problems that you discussed, and in particular the second one. Keynes, to some extent, was more or less confident about the ability of short-term interest rates to control, or at least to cope with, long-term interest rates. Mm-hmm. So, in a sense, he was confident that the manipulation of short-term interest rates would be able to sort of stabilize long-term interest rates. But I'm afraid Kalecki was not of that opinion. I think Kalecki was very much against such an idea, because he was not, he was actually concerned with the fact that it is not possible to accomplish both monetary stability and financial instability with only one instrument. So you need more than one instrument to achieve more than one goals. So I would like you to give us some insights on this.
Yeah.
Voy a permitir hacer la pregunta mía y otra que está en el chat. We saw that the rate of interest went down, the short-term rate of interest, to provide liquidity during the crisis. This was needed at the very moment of the crisis. The problem is how to manage the yield curve to provide liquidity and target or manipulate the long-term liquidity in order that the capital markets will not provide finance, but will provide liquidity for corporations, because we know that capital markets don't finance investment. And then I want to get to the second issue. It's regulation. We know that part of the crisis, the banking crisis in the US and now in Europe, partly is because of regulation. Mm-hmm. Partly it's because it was the Dodd-Frank during, what's his name, the crazy one,
Trump.
During the Trump administration, was deregulated for short-term, for small banks. And in this sense comes the question of international banks in developing countries. How you regulate them? Because in Mexico, they have huge return, but it's the problem of the government. Well, not the government, the problem of the central bank, because they only hold treasury bonds.
Yeah.
Risk-free and high interest margins in terms of the long term. Now I will read you that was wait. There is another question in the chat of the people. Okay.
Let me get it. Okay.
We lost it in the.
Dice, in your point of view, the Credit Suisse financial crisis is an infection between SWIFT system and the liquidity potential of the cryptocurrencies, and what's the correlation with the collapsed FTX? I don't know.
Oh, FTX, the collapse.
Okay.
FTX is cryptocurrency. Okay. Oh, okay. Shall I say my gossip about Credit Suisse?
Yeah, you're in a free country.
Okay.
Not everyone.
No. The Credit Suisse exemplifies the political problems that bedevil, international banking. Credit Suisse is a very reputable, historically important Swiss bank. If you ever go to Switzerland and you travel on the trains, you'll probably not be aware that the trains in the railway system in Switzerland was built using finance from Credit Suisse. Credit Suisse financed all of this historically, so it's hugely important. Credit Suisse had it has been going through the similar kind of difficulties that a number of other banks have been going through, and their present crisis was set off. They have important shareholders in Saudi Arabia, funds in Saudi Arabia and in Qatar, and the present crisis was set off because I think the Thursday from 3 weeks ago or so, the Qatari shareholders announced that they were not putting any more money into the bank. So something had to be done. And the way the Swiss authorities did this was that to make the balance sheet balance, they wrote down the contingent convertible bonds which had been issued by the Credit Suisse in order. These are bonds which are issued by banks. They offer a slightly higher rate of interest, but the understanding is that when if a bank gets into difficulty, the first call is, of course, on its reserves. After its reserves have been wiped out, then the shareholders' funds are then wiped out. After the shareholders' funds have been wiped out, then the contingent convertible bonds are supposed to start being wiped out. What the Swiss authorities did was they wiped out the contingent convertible bonds before wiping out the shares, which is a reversal of the standard banking practice. And I think this is what caused outrage. And in fact, the European Central Bank, the other banks in Europe started being a little bit insecure with the European Central Bank and the Bank of England both intervened to say that no, they would ensure that the shareholders' fund, that the traditional, the usual priority would still hold. In other words, the bondholders' funds are not touched until after the shareholders' funds have been eliminated. Now, that's important. Why? Because a lot of hedge funds have got involved in these convertible bonds. Why? Because the week before Credit Suisse collapsed, it issued its a tranche of the contingent convertible bonds at an interest rate of 9.75%, phenomenally high for a European bank in Switzerland. Clearly a sign of difficulty. So what I'm pointing out is that this shows the political nature of the difficulties. How to manage all these finances, I think, to a great extent. One thing that is increasingly being spoken about, and I've been working on, is the issue of debt management. The government has to ensure, the government and the central bank have to ensure through their debt management that they can ensure that markets for bonds are liquid. And this is where yield curve management comes into it, because if you manage the government debt in such a way that the yield curve is stable, you ensure that, first of all, there is always a market for government bonds at that rate of interest. And secondly, that banks and corporations can get liquidity. Differences between short-term rates and long-term rates, according to Keynes and Kaletsky. Keynes actually, Keynes put forward his argument about short-term interest rates influencing long-term rates most strongly in the treatise on money. Why? Because this was 1930. This was coming to the end of Britain's participation in the gold standard, which Keynes criticized, and his reason, the reason for his criticism was that he believed that if Britain went off the gold standard, the interest rates could come down and the economy would recover. Britain went off the gold standard in 1931, and interest rates were halved, and actually it had very little effect. And this is why you do find references still to this in the general theory, but then they're qualified, and Keynes starts talking about uncertainty and animal spirits, all these other factors which mean that maybe the long-term rate of interest won't respond so quickly. I think Kaletsky had, by that time, by the way, there were a whole series of studies which were undertaken on long-term interest rates, and people like Hawtrey, Shackle, Robertson, Kaletsky himself showed that actually long-term interest rates don't change very much. So Kaletsky, this was an argument as to why really the long-term interest rates don't have that important a function. They still have an important function actually for funding purposes, and that is why that is their function rather than for investment purposes. Income distribution and finance. Yes, Kaletsky was very concerned about this. I think in particular around the issue of poverty and unemployment, because Kaletsky was and I think most Keynes, possibly Keynes as well, but many people at that time started to become very critical of the doctrine of the immiseration of the working class. The doctrine, there's a doctrine that which was particularly prevalent among certain sections of the followers of Marx, that the worse it is, the better it is for the revolution, because the workers will become revolutionary. Kalecki knew, and many people who lived through the 1930s knew that, in fact, what happens is that the worse it is, the more those who are unemployed, those who are on the insecure, gravitate towards fascism and nationalism. And this is what was actually happening in the 1930s. So you cannot rely on the immiseration of the working class to create a move for social improvement. You have to do it through redistribution of income, through welfare state, and promoting full employment as a way of giving confidence to workers. That's the essence, I think, of critical aspects of full employment. Cryptocurrency, I cannot see the advantage of cryptocurrency in an era of fiat currency. I don't see how cryptocurrency lacks the flexibility of credit money, but it becomes highly promoted, and I guess the interest in it in recent years is a symptom of how the response of central banks to the problems in the financial markets of making the money markets liquid has resulted in excessive liquidity. Excessive when money goes into speculative ventures like cryptocurrency, that's a sign that there's too much liquidity. There needs to be stricter control over that kind of liquidity. Control of liquidity needs to be part of debt management and yield curve management. As far as monetary policies, cryptocurrency is useless already for monetary policy. Governments need to control their own currencies, but they need to control them not just by issuing their own currency, but by managing the bond markets in their own currency. Credits, problem of credits for industrialization under foreign influence. This is an old problem of the politics of economic development and industrialization. Yes, it's necessary to have an industrial strategy, an industrial policy. It doesn't necessarily mean that it all has to be government owned, but the government needs to know what priorities there are for, if only for the sake of ensuring that there isn't excessive investment in particular sectors, causing, let's say, in industrial sectors, causing pressure, putting pressure on markets for consumer goods and the rate of inflation and so on. So yes, it should be a part of economic planning and strategy. Whether these should be done through foreign companies or not, yes, some credits are useful. The fact is that if a country is industrializing and needs to borrow, needs to buy equipment from abroad, it is helpful to use foreign currency credits. But it's helpful. That also needs to be planned. Thank you.
Thank you very much. Sorry, but we don't have too much time for more questions. And I only want to thank you, Professor Toporowski, for your marvelous presentation and this nice discussion. Thank you very much. Gracias a todos por estar acá.